to finish up with financial instruments. We started last week, and today the plan is for us to round it up. And from our last week class, I introduced financial instrument to you, and I basically started with telling you that financial instrument is basically all about debt and equity instruments. And I went further to tell you that for this standard, we are going to be using IS 32 and IS and IFRS 9. We started out with IS 32 last week, and IS 32 helped us define some key terms, like what a financial instrument is. And it told us that financial instrument is any contract that gives rise to financial assets of one entity and financial liability or equity instrument of another entity. From that definition, we went ahead to explain what financial asset is, what financial liability is, and also what equity instrument is. And I pointed out in my explanation that to identify the party that has a financial asset is relatively easy, because the party that has financial asset is usually the investor, the person that gave out money. The technicality arises in identifying which party has what the issuer has, what the other party has, because from here it said they can either have a financial liability or an equity. So at every point in time, you need to be able to establish and be able to know what the issuer has issued, what he has. And I spent a lot of time on this. I gave you several scenarios around financial liability and equity, understanding when he issues an instrument, what is that instrument? Is it a financial liability or is it an equity? And I can remember I also gave you an assignment, which some of you did. Which some of you did. So that assignment will have really exposed you to a lot around identifying what the issuer has, whether he has financial liability or an equity instrument. But the substance of identifying the difference really is in understanding the definition of financial liability. Understanding that financial liability is a contractual right, a contractual obligation to deliver cash. If we are not delivering cash, then it is not a financial liability. So there was even one of the questions I gave you. The question was asking that a company issued, let me see if it's here, I'm not sure. It's not here. So a company issued a debt instrument, and it is not compulsory for him to pay interest. So whether he pays interest or not, that is at his own discretion. It is at the issuer's discretion to pay interest or not to pay interest. So the answer to that was that the issuer has an equity instrument, that what he has issued is an equity instrument. And the reason is that for the fact that paying interest has become not compulsory, that he pays at his own discretion. That shows that The issuer has no obligation to deliver cash. He has no contractual obligation. Therefore, it is not a financial liability. So that's the core thing. If there is no obligation to deliver cash from the standpoint of the issuer, then we know that you are dealing with an equity instrument. So this part of IAS 32 is extremely important. And I mean, you have all the resources with the assignment I gave you, with all the scenarios we looked at, and the solution I've sent to you. I'm sure that should help you take care of that. Furthermore, last week also, we started with recognition and the recognition of financial instruments. I'm not sure if we did this last week. I'm not sure. Has anybody revised our classes last week? Did we touch on recognition and the recognition of financial instruments? I think we did, because I did for every other center. So I want to believe that we also looked at it here. So for recognition of financial instruments, we mentioned that an entity would recognize financial instruments when the entity become a party to the contract. When an entity becomes a party to a contract, then it can recognize that instrument in its books. And an entity becomes a party to a contract either at the date of the agreement or at the date of commitment. Either when you have agreed there's a contract, or when you have made commitments, you have made payments, then you can go ahead and recognize the financial instruments in your books. For the recognition, we looked at the recognition of financial assets first. And the recognition, by now means removal of an item or element that you have recognized in your books before. Now you want to remove it from your books. So the recognition of financial asset can only occur if the contractual right to the cash flows have expired, and if the entity has transferred substantially all the risk and reward of ownership of the financial asset to another party. So before you can recognize a financial asset, these two must exist. These two must be present. Your contractual right to cash flow must have expired, and there must be transfer of substantially all risk and reward. And a typical example of this is if you have an entity that has, let's say, a trade receivables. A trade receivable is a financial asset. So if the entity needs money urgently, they need money urgently, they now decide to sell that trade receivable to another party, meaning that the other party will be ready to give them money immediately, while the other party will go ahead to pursue those receivables. Of course, he's not going to give them all the money because he will keep some for himself as profit. It's just like having a trade receivables of 5 million. So you can just walk to a factoring company that will be ready to give you 4 million, while they will go after that 5 million receivables. So they are looking at a profit of around 1 million. Of course, they'll also incur some cost of recovery and all of that. But ultimately, the guy, the original owner of that trade receivable have sold it. So one would expect that he would recognize it in his books, because at that point in time, his contractual right to cash flow have expired. He has collected all his money. He has sold the trade receivable to another party. But however, if there's somewhere in the contract where it is stated that the the seller of that trade receivable, the original owner of that trade receivable, would compensate the other party for losses as a result of irrecoverability. That is, if the other party is unable to recover that trade receivables, they can still come back to you and ask you for payment. That, okay, we were unable to recover this receivable. Can you give us back our money? So if there's a clause like that, that means that that entity has not transferred the risk. If you are still carrying credit risk, the risk of non-payments, if those parties can still come back at you and be asking you for payments, that we were unable to collect this receivable, oh, can you give us back our money? That means you have not transferred the risk. So that means this second has not been met. And when that has not been met, that means you cannot derecognize the trade receivables. You cannot. So before you can derecognize the trade receivable or financial asset generally, these two must happen. Your right to receive cash must have expired, and you must have transferred substantially all the risk, all the reward attributable to ownership. Another scenario is if an entity has a loan receivable. They have a loan receivable, but they need money urgently. So they went to a securitization vehicle to securitize it, meaning they went to sell it. So they collected money outrightly. And they asked those people to go after those loan receivable. So with that, it means that their contractual right to cash flow have expired because they have collected money and they have transferred that right to another party. Again, if there's a place in the contract where it states that the entity would also suffer some losses if that party is unable to recover those loans, that they would be required to compensate them, it shows that they have not transferred the risk. Or if somewhere in the contract there's a statement that says that if the company is able to recover those loans, that they will compensate you, they will give you some percentage of it. And that means you are still getting reward from the loan you claim you have sold. That means you haven't transferred the risk and reward. So before you can recognize financial asset, these two must happen. These two must exist. And that is it about the recognition of financial assets. Do you have any question on this?
So sorry, that means any fund or money that is being received will be treated as loan until it is fully transferred, right?
Yes.
Okay.
Okay. So what Lukman is saying is that remember that I said that the guy sold the loan receivable, or he sold, let me use the trade receivable, he sold his trade receivable, meaning that he collected money. Meaning that he collected money. But because he's still guaranteeing and he's still going to compensate them for losses, we are saying don't derecognize it. So that means that trade receivable will continue to be in his books. But he has collected money. So he's asking, if I get this question right, that money you received, let's assume that you received 4 million. That money he has received for that receivables that he sold, how is it going to be treated? Because ordinarily, that money he received should have been used to net off the receivables in his books, should have been used to derecognize the trade receivables in his books. But now the standard is saying no, he cannot derecognize it. So how are we going to treat that money he received? So he's right. We are going to treat it as a liability. That money he has received it will credit financial liability because as it is now, he has an obligation to deliver cash. He has an obligation to return that money because the standard is saying he cannot derecognize it.
Thank you.
Any other questions, please? Okay, good. So the next one is the recognition of financial liabilities. So for financial liability, it's derecognized when the obligation is extinguished. And when we say extinguished, we mean when the obligation is either discharged, is cancelled, or the obligation expires. That's extinguished, whether you have discharged it, that is, you have settled it, or whether they cancelled it for you, or whether the time for repayment has elapsed, it has expired, or probably maybe you yourself, you can sell that financial liability. It has expired. It no longer exists. Then you can extinguish it. You can remove it from your books as soon as that has happened. So, I mean, you need to understand extinguishment. I mean, there was a scenario like a company borrowed money, he borrowed money, and so maybe after like 2 years, they were supposed to pay back the money like after 5 years. So after like 2 years, that money they borrowed like 100 million. So they have already saved up 100 million back to repay. So they have it in their savings that, okay, we have this money to repay back the loan we borrowed. So on the ground that they have the money to repay, then they went ahead and they recognized the financial liability, saying that, hey, maybe we have the money. So we have to advise them that no, you cannot de-recognize it on the basis that you have the money. You cannot. You can only recognize it when it is extinguished. You haven't extinguished the liability. You haven't discharged it. It hasn't expired. It's what's neither cancelled. So you have to continue to put it in your books until it is actually extinguished. So that's the major idea behind the recognition of financial ability. And when it comes to the recognition, there are some things I'll just gloss over this. We really don't have to pay so much attention to this part, but since it's here in my notes, so you see, it's possible to exchange one financial instrument for another. It's possible. Exchange. You change. So when you change, of course, the one that is leaving your hand is you do recognize it is an extinguishment. Also, it's possible to modify the terms of a liability. When we say modify, we are talking about when there is a change in interest rates, when there's a change in the term, or when you're supposed to pay back, and a lot of other terms on the financial liability contract. That's a modification. Modification can also result in extinguishment. And that's if it is substantial. And substantial is, I mean, when the differences in cash flow between the old terms and the new terms is at least 10%. That's a substantial modification. And it will result in extinguishment. Also, when you derecognize, right, it's possible that the amount you settle might be lower than the book value of that loan. So it can result in you making a profit or a loss as the case may be. Okay. So those are just other issues around the recognition. Any question on the recognition of financial liability? Okay. Now, still on IFRS 9, how do we measure financial liability? How do we measure it? And you know that when we say measurement, we are talking about the amount that you attach to that loan, how much the amount that you attach to it. So, sorry, I'm coming. Okay, so the amount that you attach to that loan. So, how do we then measure financial instruments? We'll look at the three elements that we have: financial assets, financial liabilities, and equity. And we'll look at them one by one. So the first one is financial assets. How do we measure financial assets? So, see, financial assets, you already know that there are three financial assets that we have. There is cash, there is equity interest in another entity, and there is contractual right to receive cash. So financial asset that is cash, how do you measure it? That one is straightforward because cash is either the money you have in your hand or the money you have in the bank. So your cash is your cash, and you know the amount of cash you have, which is what will be in your books. But the other two, which is equity interest in another entity, I will call that equity investments. When an entity invests in either debt or equity. So the equity investment part is when you buy shares in another company. That's financial asset. And also debt investments, which is contractual right to receive cash. You see, these are the two we're going to focus on for measurement of financial assets. So firstly, all financial assets, whenever you invest, whether you buy shares or you buy debt, they are initially measured at transaction price. All financial assets are initially measured at transaction price, and it's logical because transaction price means the amount that was invested or the price that was paid for the instrument. That is transaction price. The amount that was invested or the price that was paid for the instrument. That's transaction price. So it makes sense that that is the amount you should recognize that investment in your books and the transaction price. So if you buy shares of 10 million naira in your books, record it at 10 million, measure it at 10 million. If you buy shares of 5 million in your books, it should be 5 million. Or if you invest in debt in your books, put it there as whatever amounts that you invested. So majorly, that is how we measure financial assets initially. So let's take it one by one. Let me start with equity instruments. When you invest in equity instrument. So when you invest in equity instruments and you put it in your books at the transaction price initially, we need to understand before you recognize it in your book first, we really need to understand why you have bought those shares, why you have invested in that equity. And the reason is that there are more than one reasons why people will buy shares. It's different from when you buy things like PPE. If you buy air conditioner, everybody knows why you will have bought an air conditioner. Or if you buy motor vehicle for your staff, it's clear why it is bought. So most of these physical assets, you would know why you have bought it. But when people buy shares, there are more than one reason why you would buy it. And when there are when there are more than one reason why you bought an asset, it's possible that they would represent or have different treatments. And that leads us to classification. A financial asset or equity investment needs to be properly classified. And the classification depends on your intention of buying it. When you tell us why did you buy it, then we'll be able to classify. It's just like land and building, for example, now. If you have land and building that you are using for administrative purposes, that one is PPE. But if you have land and building that you hold for rentals or capital appreciation, we say that one is investment property. So intention for buying would make an asset have different treatments. So the same thing here too. We need to properly classify that financial asset based on your intention for buying it. So before you enter an equity investment in your books, we need to be able to know what's your intention. Why did you buy these shares? You see, IFRS 9 identified two reasons why entity will have bought shares. It says that it's either they have bought it to hold it for short term or for trading, or they have bought it to hold it for long term. So those are the two reasons why companies would have bought shares. It's either they bought it to hold it for short term, or they bought it to hold it for the long term. And you see, when we say that you bought shares for short term or you bought shares for trading, it simply means that these shares that you bought, you have the intention of selling it. It might not necessarily be this year you will sell it. It might not be next year. It might not be next 2 years. It might not be next 3 years. But it's the intention we are speaking to here. When you have the intention of selling, then that means you are holding it for trading. So it's not about the period of holding. No, it's about the intention to sell. It's that intention. So if you don't have intention of selling, it's not even, you just bought it for investment, that I bought this thing. Then that one can be categorized as long term. Even if you now end up selling within 1 year or after 1 year. But the fact that when you bought it, the intention was not there. You just bought it and you didn't have plans of selling. You will classify that as long term. Okay, so knowing this basis now, knowing this intention, we're not saying that if the intention is to hold for short term, that investment in equity instruments will be classified at the date of acquisition, the date you bought it. You are going to classify it at fair value through profit or loss. You are going to classify it at fair value through profit or loss. But if the intention is to hold it for the long term, then that investment in equity instruments, you're going to classify it at fair value through other comprehensive income. You're going to classify it as fair value through other comprehensive income. So from the above now, we are saying that investment in equity instruments can be classified into two. is either we classify it at fair value through profit or loss, or we classify it at fair value through other comprehensive income. And this classification is done at the date of acquisition. So for example now, if Wasi PLC bought 5 units of shares of BPLC, he bought it at 2 naira each on 1st January 2024. We're now told that Wasi intends to sell the shares before the end of the year. How would this investment be initially measured and classified? You see, the initial measurement is at transaction price, which is the 5,000 units multiplied by 2 naira per share. We'll be looking at 10,000 naira. We're told that we intend to sell the shares before the end of the year, which goes to show that we are holding it for trading or for the short term. And from here, we say that if you are holding it for trading or for the short term, you should classify it at fair value through profit or loss. So that goes to show that this guy in his books, when he recognizes this investment at 10,000 and he wants to enter it in his books, he would have to debit financial assets, or instead of calling it generally financial asset, you can simply call it equity investment. But he needs to put at fair value through P&L so that we would know and understand the classification. This classification is so important. So the description of the account head will not just be equity investment or financial asset generally. You need to put this at fair value through P&L so that any reasonable or understandable user would immediately see and know that this financial asset is held for trading. And of course, it will credit bank. So that's what I'm talking about. Classification is important when you invest in equity. Now, also, at the beginning, you see, when you buy shares, you will always incur transaction costs, like your broker's fee, or even stamp duties, or maybe the exchange fee. That maybe you bought it from the stock exchange, they will charge you. They have their fees. So all of these fees that you pay, in addition to the cost of investment, how would you treat it? How do you treat it? So you see, the treatment of that transaction cost, those related fees, those associated fees that you pay along with that cost, the treatment depends on the classification of financial assets. You see why classification is important? The treatment of the transaction cost depends on the classification of that financial asset. You see, if the financial asset is classified at fair value through profit or loss, if the equity investment is classified as fair value through profit or loss, the transaction cost will be expensed. The transaction cost will be expensed. While it will be capitalized or added to the initial costs or the transaction price if it is classified at fair value through OCI. So if it is classified at fair value through OCI, you capitalize it. So we are saying that if in this scenario now, we have a transaction cost for 500 naira from this example I gave you. That means in this example now, that 500 naira will be expensed to P&L. because this financial asset is classified at fair value through P&L. But if we were to classify this financial asset at fair value through OCI, it means that that financial asset, it means that that transaction cost will be capitalized. That is, instead of this 10,000 that we have in the financial asset account, we would be having 10,500 now. We will be having 10,500 now. And that is all you do at the beginning of the year. When you buy the shares, you need to know you would measure it at transaction price. You need to understand your intention for buying it so that you can properly classify it. If your intention is to hold it for the short term or for trading, you classify it at fair value through P or L. But if your intention is to hold it for the long term, you classify it at fair value through OCI. You classify it at fair value through OCI. So again, when you bought shares, there are always transaction costs. When you buy shares, there are always transaction costs. And the treatment of these transaction costs depends on the classification. If the financial asset is classified at fair value through POL, you are going to treat or expense the transaction cost. But if the financial asset is classified at fair value through OCI, you will capitalize the transaction cost. Now, at the end of the year, which is subsequent measurement, at the end of the year, these financial assets will be measured, because when we say subsequent measurement, we are talking about measurement at the end of the year. How much are you putting in your book? So at the end of the year, it's either going to be also measured at fair value through POL or at fair value through OCI. Okay, you'll see that this is consistent with the classification. I mean, it's so consistent in such a way that if you classify it at the beginning of the year at fair value through P&L, at the end of the year, it is expected that you measure it at fair value through P&L. Or if you classify it at the beginning at fair value through OCI, it's expected that you measure it at the end of the year at fair value through OCI. So classification is consistent with the subsequent measurement. But when we say you are measuring it at fair value through POL or at fair value through OCI, what do they mean? I mean, what is that amount representing? So firstly, when we say fair value is the amount you would receive when you sell an asset. Fair value is like the selling price. So we are saying here that you would measure your equity instruments at the share price at that year end. Almost all equity instruments are listed, not all. I mean, for listed companies, and you can easily get their share price. So at the end of the year, you must always check the share price of that company that you bought shares in, and it will be on that basis that you're going to measure that your shares. So you'll find out that at the end of every year, the share price will change. The fair value at which you recognize it in your books will change. So now these two, they are both speaking to fair value, but one is saying fair value through profit or loss, while the other is saying fair value through OCI. What's the difference? The difference is just the treatment of changes in fair value. The big difference between the two is how do you treat gain or losses? How do you treat changes in fair value? Where are they recorded? And from the names, you would know where they will be recorded. The one that is fair value through POL, it means that any changes in fair value should be recognized to POL. The one that is fair value through OCI means that any changes in fair value should be recognized to OCI. I mean, following from this example I gave you, where this guy bought 5,000 shares for 2 naira, you know that at the end of the year, the share price will not remain at 2 naira. So let's assume that let's say at the end of the year, the share price, let's say the share price is now 3 naira. Let's say the share price is now 3 naira, which means that the value of the shares that this guy has now, the value of the shares will now be 5,000 units. 5,000 units times how much? Times 3 naira. So his value is now 15,000. But remember, this same 5,000 shares in his books at the beginning of the year was only worth 10,000. But now, because of changes in share price, it is now 15,000. So that means this guy has made how much? He has made 5,000 naira gain. So which is what we are saying, that this gain, how do you treat it? So if you are measuring your investment at fair value through POL, that means this gain, you're going to recognize it to POL. But if you are measuring it at fair value through OCI, that means this gain is going to go to OCI. It's going to go to OCI. Are you getting it?
Yes. But I have a
Okay.
question there. This
Okay, please.
gain now, if you take it to profit and loss, it's not taxable because you have not received it.
Yes.
Okay.
The taxman, it's more of an exempt income.
Okay.
Any other questions, please? Any other questions? Okay, so if I may ask you, right? So if you measure this at, let's say, fair value through POL and you make a gain, making a gain means you are going to credit this to P&L. Where do you debit? Where do you debit? Anybody? You did not ask me. That means you are, I actually felt you knew it. Where do you think you will have debited? Can just try. Nobody is going to bite anybody.
I'm thinking since it's held for short term, it will be under, let me see, yeah, how is it current?
You don't even have to think too much. The whole idea of this gain is that it's the value of our investment has increased from 10,000 to 15,000. So you just simply debit the financial assets to increase it from 10,000 to 15,000. Okay. No, Jacinta said to reduce. No, it's to increase it though. It's a gain. So you debit the financial assets from to increase it from 10,000 to 15,000. So you simply debit your financial asset and credit P&L. The same thing for this one too. If it is fair value through OCI, you are going to credit your OCI and debit your financial assets.
So
Yes, Jacinta.
initially, when you added associated fees in financial assets, like you added it, like it increased the financial assets. But me, I was thinking that when you make gain, it will help reduce the assets. Mm.
No, no. Making a gain, your assets increase. It's very clear here now. Your asset was 10,000 before. Now it is 15,000. Is that a gain? Is that an increase or a reduction?
It
It
increase
was,
this. Mm.
that's an increment. So you debit the financial asset and you credit P&L. And you were talking about associated fees and all of that. I've actually mentioned that in this class, and I don't think you should conclude that they are added to the assets. No. What I just taught you today is that it depends on the classification. If the financial asset is classified at fair value through P&L, any transaction cost or any associated fees would be expensed. But if the transaction cost or associated fees will be capitalized if the financial asset is classified at fair value through OCI. So please, you need to be speaking with reference to what the new things you have learned like that. So now, this gain now, like the last thing I said is that if the investment is measured at fair value through OCI, this gain will go to OCI. To go to OCI. And the corresponding debits will be in financial asset. Corresponding debit will be in financial asset. And that is everything around equity investments. That's everything around equity investment. Do we have any questions? Do we have any questions? Okay, since you're not asking, let me ask you a question. So let's say this financial asset is measured at fair value through OCI, right? You now made a gain of 5,000. I told you, you will take it to OCI. I said you will take it to OCI. Let's now say in year 2, it was now a loss. Let's say it was a loss of 7,000 in year 2. In year 1, you made a gain of 5,000. And because assuming that this investment is measured at fair value to OCI, so that gain goes to OCI. I'm saying now that let's say in year 2, it was now a loss. You made a loss of 7,000. My dear student, how do you treat this loss of 10,000? How do you treat this loss of 10,000? Anybody?
Sorry, it's a loss of 7,000 in year 2. I will just offset the from 5,000 gain year 1, and the remaining 2,000 I will take it to P&L.
Fantastic. Thank you very much. Thank you very much. Is it why I'm saying thank you very much? It's not because you are correct, but it's because you were able to apply the knowledge you have taught you before, and that's fantastic. Keep that up, and you do very well. So that means you remember exactly what I taught you in PPE. So in PPE, that will have been correct, because that's what I taught you. That when you have a revaluation surplus in the previous year that goes to OCI, when you now have a loss, a revaluation deficit in this current year, that you are going to net off that loss against the last year surplus first, and it is in OCI, and it is any excess that you now take to POL. That is what we taught you. But it doesn't apply here. It doesn't apply here. You see, this entire 7,000 here is going to go to OCI. There is no need to net off and take in, because here, they were very specific. They have already classified these items. They have measured it very clearly. That one is fair value through POL, while another one is fair value through OCI. They are very clear. So the one that is fair value through OCI, for example, now, any gain, any loss, gains or losses, take them to OCI. So the issue of ultimately taking it to P&L will not fly, because this one is so specific. Fair value through OCI. Whether you make a gain in a year, you make a loss in a year, take it to OCI. The one that is fair value through POL, whether a gain or a loss, take it to POL. So speaking to this one, if you made a gain in year one, and this thing you're measuring it at fair value through OCI, take the gain to OCI. In year two, when you make a loss and it's measured at fair value through OCI, take the loss to OCI. It sits there every year. OCI, 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 OCI. So I needed to make that clarification for your knowledge. Okay. So I'm making progress. Investment in debt instrument. Investment in debt instrument. Okay. So you see, this is also under financial assets. This is the other part of financial assets. When you have contractual right to receive cash, and you see, investment in debt instruments means you have invested in either bonds, government bonds, or corporate bonds, or you gave loan to somebody, or you invested in commercial paper. I mean, the whole idea is that you lend money to someone. And you know that the nature of debt is that you get interest and principal. You always get interest every year, and you would also get your capital. So majorly, what we want to learn here is around how do you treat the interest, how do you treat the principal. That's the major issue around its measurements. How do you treat the interest? How do you treat the principal? That's the major measurement issues here. So again, similar to what we learned under equity, you would really need to understand first how you're going to classify these debt investments, because there are more than one way of classifying it. And this classification is coming up because there are several reasons why somebody will have bought shares. I said shares, debts. There are several reasons, okay? And ultimately, your reason would determine the classification. And to fast forward knowledge, there are three classifications. There is amortized cost, there is fair value through OCI, there is fair value through POL. Those are the three classifications that we have. Amortized cost, fair value through OCI, fair value through POL. Okay, now, what is the basis for classifying in any of these three? Okay, firstly, you see the classification of debt instruments is based on two things. It's based on two things. Number one is the entity's business model. And number two is the contractual cash flow characteristics of the financial assets. Those are the two bases. Remember the basis for equity. That one is when if you are holding it for trading, or you are holding it for long term. This one, the basis is the entity's business model for managing the financial assets, and also the contractual cash flow characteristics of the financial assets. Okay. Now, firstly is the business model. What does that mean? You see, every business has a business model. every business in the world. Like our school now, Equity Professionals, our business model is you log in online, we teach you, you pay for your lectures, we teach you for 3 months or 4 months, you go and write the exams, you pass, you come back, we teach you, you pass. That's how we make money. That is our business model. A company like banks, for example, now their business model is they collect deposits, and one way or the other, they find a way to use that money to earn money. And also, they also give loans by charging interest. That is their business model. A company like Google, for example, their business model is they have a search engine to make people search for whatever free of charge. Then, one way or the other, they find a way of making money by advertising to you, by showing you some sponsored posts. And that's how most of these social media platform makes money. I mean, when Instagram just started, they had no business model. They had no way of making money. They were not making any money. But when Facebook bought them for $1 billion, they created a business model for it and they started making money. When we say business model, we're talking about how do you intend to make money. So returning back to what we are looking at today, debt investment. We are saying that what is your business model, which means how do you intend to make money from this investment? And you see, generally, for debt investments, there are 2 ways to make money. 2. Number 1 is either you might want to solely collect interest and principal. Some people, the only reason why they buy commercial paper or government bonds is because of interest. They just want to be collecting interest. Some people, by the time they have so much money, let's say they have like 500 million, say, me, I'm not working again. I don't want to do anything for anybody in my life again. So they will just go and dump that money with maybe a finance house. And those ones will say, okay, we'll give you 30% every year. 30% of 500 million is around 150 million. So they will just help him break it down every month. Every month, the guy will be collecting close to over 10 million, over 11 million. And he's living his life. He's not doing anything. He's gallivanting around and his principal is there. That is his own intention. That is how he wants to make money. But some people, their own is more than that. But you need to understand first that every debt investment will earn you interest, right? But some people don't just want that. They want to trade with it. So in addition to collecting interest and principal, they also want to sell when they have opportunity for an higher yield. So anytime they see that they can earn higher interest somewhere else, they will sell this current investment they have and go and use it to buy another one. Yes, you can sell debt investment. Debt investment are also listed, majorly listed on FMDQ. You see their prices there. You can sell, then buy another one. So these are the 2 ways in which you can make money from a debt investment. Either you just want to collect interest and principal and you're fine. Or in addition to collecting interest and principal, you also want to what? Sell. The second basis is contractual cash flow characteristics, which is saying that there has to be a contract that would specify or that will show that you will actually collect interest and principal. You see, this is necessary just so that we can see, we can confirm and verify the interest you claim to be collecting and your principal you say you're going to collect back as at a specific future date. We want to verify that. And the way to do that is for you to show us a contract. So this contractual cash flow characteristic is saying there has to be a contract that will show that. However, because this second basis is redundant, it's like a presumed basis. It's always there. There is no way you could have a debt instrument without a contract. So in your exam, you will see what ultimately determines classification that ICAN exams will ask you is this business model. Is the business model. Now, since we have three classifications from what I've told you up here, amortized cost, fair value through P&L, fair value through OCI. So what will inform you to classify at amortized cost? What would inform you to classify at fair value through P&L? What would inform you to classify at fair value through OCI? It's these two bases, right? So you see, for amortized cost, you can classify a debt investment at amortized cost if your business model, okay, is to hold the financial asset solely to collect interest and also receive principal at maturity. If your business model is solely to collect interest and principal at maturity. But, and also, of course, I told you there is contractual cash flow characteristics, meaning that the terms of the contracts must show that you collect interest and principal. The terms of the contract must show that you collect interest and principal. So if your business model test is to collect interest and principal, then just put it at amortized cost. However, let me check the second one before I go to calculation. However, for fair value through OCI, your business model must be that you will collect interest and principal, which I call contractual cash flow here. And also, you also have the intention of what? Of selling the asset. You also have the intention of selling the asset. Then, if you have that, if it is those two, then you should classify it at fair value to OCI. And of course, there should be a contract that will show that you earn interest and principal. There should be a contract that will show that. Like I told you, you will see that where the difference is arising is in the business model. For the amortized cost, your business model is that you want to, the way you want to manage this financial asset is to solely collect interest and principal. But for the fair value through OCI, the way you want to manage is to, in addition to collecting interest and principal, you also want to sell. And that's that. And the final category is fair value through POL. And for the fair value through POL, this one is a default classification. What do I mean by default classification? That is, if you cannot classify at fair value through OCI or amortized costs, we usually use fair value through P&L. Is a default classification. And again, saying is a default classification also means that if you decide, an entity can decide at initial measurement or recognition that he wants to classify and measure these debt investments at fair value through P&L. He can do that. He can decide right from the outset that this is how he wants to measure it. And decide that. So fair value through POL is a default classification. And also, even in the equity investments that we mentioned earlier, that also fair value through P&L there is a default classification. In the sense that if you don't know whether you want to hold it for the long term or for the short term, you're not sure, you assume is fair value through P&L. The same thing for debt investment as well. So those are the basis for classifying a debt investment. Okay. And again, just like the previous equity, the way you have classified it is exactly how you are going to measure it. The classification is the same thing as the measurement. So you also measure this debt investment at amortized cost, at fair value through P&L, or at fair value through OCI. At amortized cost, at fair value through P&L, or at fair value through OCI. Now, I've already shown you the difference between fair value through P&L and fair value through OCI when it comes to measurement. The difference is just in when there is a change in fair value, where do you take the gains to? That is where the difference lies. When there is change in fair value, where do you take the gains to? That is where the difference lies. If it is fair value through POL, you take the gains to POL. If it is fair value through OCI, you take the gains to OCI. The same thing applies to this one also. So the only one I have not mentioned is amortized cost. Let me use this to explain amortized cost. Let me use this to explain amortized cost. After explaining amortized cost, I will most likely stop because I have very few students here today. I will leave financial liability so that those people, because of the impromptu information, I will be able to use it to revise with them also so that they can also gain. So, how do you determine amortized cost? So now, you see, the principle around amortized cost is just saying that interests, because it relates to debt investments where you collect interest. And usually interest is calculated on the amount outstanding, usually. So let's look at a simple scenario, then we'll look at a more advanced scenario to determine amortized cost. So let's start with the first one. So on a 10 million 5% loan with 10 million repayable at the end of the 3-year term, interest will simply be recorded at 5,000 naira every year. Okay. So this is a situation where you invested in a 10 million naira 5% loan, and at maturity, which is at the end of the 3rd year, you are going to get back your 10 million. So, like I've said here, this is a popular one. This is the one everybody does, no complexity. It means that you are getting 5% every year. So that means you are going to record 5%, 500,000 every year. So that means from year 1 to 3, we'll be collecting interest of 500,000. We'll debit bank, you credit finance income. Year 1, year 2, year 3. And at the end of the 3rd year, they will pay back our loan. There will be repayment of the loan. We'll simply debit bank and credit loan receivable, or you credit financial assets with the 10 million, because we're going to get back our 10 million. And don't forget that as soon as you invested also, which is on making the investment, or let me use a more technical term, on origination of the financial assets, meaning when you make the investment, you simply debit financial assets. Let's assume that it is at amortized cost, since I'm teaching you how to calculate amortized cost, and you credit bank with the transaction price, which is 10 million. So that's on origination of the financial assets when you invest. So from year 1 to 3, you'll be collecting interest at the end of each year. And at the end of the third year, they pay you back your loan. This is a very simple one. However, let's assume that, this is another example. Let's assume that the terms of the loan is now 10 million naira loan, which was issued on 4th January 2001. The holder will get 5%, and you are going to get 11 million back at the end of the third year, which is 31st December 2003. Okay, let's say this is the scenario. So this guy invested 10 million, he gets 5% every year, and at maturity, he gets 11 million back. See, the difference between this one and the previous scenario is this extra 1 million. Is the extra 1 million we are getting. Look at it. We invested 10 million. We are getting back 11 million. So in addition to this 5% we are getting every year, we are also going to make 1 million at maturity. So in this case now, how do you recognize the money you're making? Because the money you're making now is much more than the 5%. You are making an extra 1 million. So if you recognize this 1 million at maturity, you'll be very wrong. That would be very wrong. If you wait to maturity before you recognize this 1 million as income, that would be very wrong. And it is wrong because it means you are recognizing income on cash basis. Because from here now, this guy he has two different finance income. He's earning finance income in different ways, in two different ways. He's earning 5% every year. He's also earning 1 million over the 3 years in the form of receiving more money back than they invested. So those two finance income he's earning, you need to recognize the two over the 3 years. The 5% per year, that one is straightforward. We know that 5%, we recognize that 5% every year. But the technicality comes with this 1 million that we are going to collect in the third year. But we are saying it's wrong for you to recognize this income in the third year because this income was recognized over the 3 years. Because this income was earned, this income was earned or is earned over the 3 years. Because the only reason you are earning this extra 1 million is because you are holding this investment for 3 years. You know, if the guy should sell this investment before the end of the third year, he will lose this money. He will lose that extra 1 million. So that extra 1 million should be recognized over the 3 years. It should be recognized over the 3 years. Then how do you do that? How do you recognize it? How do you spread this 1 million over the 3 years? That's the major challenge. You see, IFRS 9 requires that extra 1 million, you would convert it to like a rate. You will use a constant rate. Just like the way this fixed interest is a rate. So it was easy for us to recognize every year. The same thing, this extra 1 million too, they would help you convert it to a rate. Okay, so the method we use in spreading that extra 1 million, we call it an effective interest rate method. So the examiner will give you what we call an effective interest rate. For this particular question I'm showing you, the examiner will have given us an effective interest rate of 8.08%. And this 8.08% represents the entire finance income we are now earning. we are earning, which is the 5% per annum plus the premium. That is why it is 8.08%. It encompasses the two, the 5% and the 1 million naira premium. So this 8.08% is what will now help us spread that 1 million over the 3 years. So we are saying that instead of recognizing only 5% as income every year, in order to capture that 1 million also every year, like a portion of it every year, we said use an effective interest rate. The examiner will always give you this effective interest rate. So it is a rate that will have captured all your flow of income. So what goes to P&L every year is this 8.08%. And for us to show it, we use an amortization schedule like this. So in year one now, we'll have, what was our investment at the beginning? We invested 10 million. Then our effective interest, our effective income or interest is 8.08%. If you apply this 8.08% on 10,000, it gives us 808. However, even though this is what we recognize as income to P&L, what we actually receive is 5%. That is the contractual rate. That's the nominal rate agreed. But because we are earning a premium also, we are saying that, okay, our income is more than 5%. Our income is actually 8.08%. But it's not this 8.08% we are getting in year one. We're only getting 500. Remember that the extra 1,000, we are getting it at the end of, they will pay it along with the principal. So when we receive this 500, out of this 808, remaining 308 that is receivable, you just add that to the 10,000. So the balance in our financial asset account will be showing 10,308. Which goes to show that in year one, this 808 will show in our P&L as income. In fact, the double entry is like you are crediting your income. You are crediting your income, you call it finance income. And you are going to be debiting your financial asset. Or you can simply debit interest receivable. But financial asset is better. You see, this 500 that you now collected, because this one you actually collected money. This is the interest that you actually collected. You debit bank. Anytime you collect money, debit bank. You credit the financial asset or interest receivable. The balance gives us 10,308. 10,308. By the time you do this plus this minus this equal to this. So fundamentally, you see, when you earn extra income in a debt investment beyond the nominal rate, you would expect that the examiner will give you an effective interest rate. And it is that effective interest rate that will become recognized in P&L. You see, this 10,308 is the amortized cost that you recognize as non-current asset. And the only reason it's going to non-current asset because we are not getting this money back until after 2 years, year 3. And this is just year 1. So you see this 10,308 will carry it to the next year. Again, you apply the 8.08%, it gives you 833, which you are going to recognize to your P&L. you receive 5%. This 5% that you receive is always calculated on the principal sum. So it's fixed. It's still going to be on 10,000, so it will be 500. By the time you do 10,308 plus 833 minus 500, you get 10,641. Again, you carry this forward. You apply the effective interest rate on it, gives you 860. You collect 500. You see, the balance will give you 11,000. The balance on your financial account will become 11,000, which is the same as what they will pay you back. So when they pay you back the 11,000, it's easy to write it off from our books. You just debit bank, credit the financial asset. It leaves your book. And everything is balanced. And also you will see that this amount we are recognizing to income every year, you can confirm that is correct, because ordinarily, since we are getting 5% per annum every year for 3 years, which is 1.5, and we are getting extra 1 million at maturity, so that means our total income is like 2.5, which we have spread over the 3 years using this effective interest rate. That means if you add these three together, 808 plus 833 plus 859, that you say is your income every year, it should give you 2.5. And if you add it, it gives you 2.5. Any amount above 2.5 is just approximation error. Just approximation, but it gives you 2.5. That's the length. This I've explained to you is the length they will go to in your exams. I will share, I mean, these are what they will ask you in your exam. They have severally asked you to do this. I will share you those 2 past questions and some other practice questions for you to practice. Okay, for the benefit of those that are not here, quite a number of you are not present, I would stop here today just so that when I'm explaining this financial ability, I'm still going to do a similar thing just for them to also benefit. So I will use the opportunity to reinforce your learning again today. But I think we have achieved something today. So do we have any questions? Do we have any questions? Okay. I noted that, I don't know, most of you did not submit my last assignment. Is it that I didn't send it on your group or something like that? But Joseph submitted, somebody submitted. So I don't know. I sent it, the one on financial instruments. Why are you guys not submitting it? That's not nice. Please, let's try and do it. Let's try and revise it. And today, I guess you have more time because you have a little extra time in between. I've taken some of it, but you have more time at the end of the day by 7:30 today. So please, let's do our assignment and have a wonderful remaining days. Thank you very much, everyone.